Let me first do a quick introduction. Who is who? Heribert Gangl, whom most of you will know. He works for Erste Group in Vienna as the head of hotel real estate financings, and he works all across the CE markets where Erste Group is active. His hotel financing portfolio includes more than 30 assets and a total financing volume of more than 700 million euros, with a wide range of assets from city hotels to leisure resorts, budget to luxury, even student housing, leased, managed, and owner-operated. Erste Holding generally finances larger volume deals of more than 15 to 20 million euros, and the current financing strategy is focused on existing hotels in operation with a track record, a strong sponsor, so the brand comes into play again, experienced operators, and international brands or affiliation. Welcome, Herbert. Nikos has been in the hospitality industry for 27 years with international experience that ranges from hotel operations with IHG and Marriott, consulting with HVS in the US and Europe, to hotel investments with Kingdom Hotel Investments in the Middle East and Dubai. You're the founder and managing director of HOTELLECT, a boutique hotel investment advisory company with offices in Dubai and Athens. And Dubai was, as I understand, recently opened, so congratulations. And HOTELLECT focuses on operator or franchisor selection, brokerage, debt, and equity financing. In the last 2.5 years, you have secured for your clients more than 210 million euros for hotel acquisitions, renovations, and greenfield developments. And in parallel, you are the exclusive development consultant for Marriott in Greece and Cyprus. Welcome, Nikos.
Thank you.
Last but not least, David Nath. You have over 22 years of experience in the hospitality sector. Before joining Cushman and Wakefield, you acted as a conducting officer of alternative investment vehicles, such as Keystone Hospitality Fund in Luxembourg. Prior to that, you worked for 7 years in leadership and managerial positions at an international private equity investment company focusing on hotel developments and operations in Europe, with almost 600 rooms in operation and close to 1,000 under development. And market tells me that you're known as being fascinated and passionate about hotels since your childhood.
Yeah, exactly. You could skip everything else.
So I hope we learn more about that very soon. Now, to the topic. Herbert, can you explain the specific financial products that your bank offers to support hospitality projects in CEE, and how do you cater for their special needs?
Well, thank you. Hello, everyone. I know we're standing in the way between brewery tour and wine tasting. It's a difficult one. Huh? So just let me briefly allow to give you some context. You already mentioned some numbers. So we, Erste Group, we have been active in the region for a long time in real estate financing for 50 years. So we have about, just to give you in context, about 20 billion of assets, financed real estate assets at the moment. About 5 to 7% are hotel real estate assets. And out of that, we do about 2.5, 3 billion of new financings each year in commercial real estate financing. And the majority is in our team. So we are based in Vienna. It's six. So we have a dedicated hotel and tourism financing team within Erste Holding. We finance directly in SCE in our core markets and support also our local banks. We have local subsidiaries like here in Česká spořitelna, for example, in Czechia. So that covers 30 hotels and a full range. So we have traditionally, the focus has been very much on city hotels, luxury city hotels. That has recently changed the last couple of years. It's more diversified portfolio now, also with resort businesses. And we've also moved into financing. I looked very closely at budget hotels and new types of product offerings, like serviced apartments has been very strong. Student housing has been a segment we've entered into in terms of financing now lately in this region. So I was talking about the CE region plus Austria. For this, with this dedicated team, I think we have a big, strong knowledge, lots of experience, good data, which allows us really in the underwriting process to look, maybe consider also financing of assets which other lenders might stay away who don't have that expertise. So we are not purely focused on lease structures, for example. We have in our portfolio, most of the assets are actually managed or own operated assets, only a few lease structures. And our core product is really property level financing. So that's where you have a clear ownership situation in SPV, which we finance. In addition to that, within the group, obviously, we can also offer other services for the industry, on the capital market side, bond issuance or IPOs, for example. So these are services we can also offer, or we do offer, and then all the treasury services and things like that. So also supporting, providing services for the operating side in terms of operating accounts and managing the daily account business and things like that. So this is our service offering for the industry in general in all our markets.
And you are one of the few in this area, I realize.
I think probably one of the few who have a dedicated hotel and tourism financing team. So in most banks, it's handled by the commercial real estate financing guys. So there's maybe one or two persons who have some experience with that, but not that, I think bundled in a specific team, which really I think gives us an advantage also in the market and discussing with clients, and having a deeper understanding of the industry is very important for us. So we're trying really to stay up to date with current developments in the hotel industry in general, not just analyze the at least property, for example.
Understood. Nikos, you are deeply involved into the hospitality sector in that region. What is your experience in securing financing for hospitality project and hospitality targets? Is it only bank financing, or is it also something else? Do you see also other financing ways? What is your view on that?
Well, first of all, good afternoon, everyone. And indeed, we won't keep you too long. We have been facing challenges with our investors, whether our investors are local from the region, hotel investment companies or high net worth individuals or family offices, or from the Middle East, again, the equivalent family offices or high net worth individuals. And I think that it makes sense for the audience to understand what's happening post-COVID. Post-COVID, as soon as we started, getting into the rebound phase of the economic cycle, we had the war, and because of the proximity of the region to the war zone, definitely that created a lot of uncertainty on the macro level. So, especially the investors from the Middle East that were actually looking into this side of the world, they became hesitant, and no one can blame them, of course. Nevertheless, as after a year of being into the war and things were becoming slightly better, if I can use that word. When we came to the region, we were being faced with quite KYC strict protocols from the banks. For any greenfield financing, it was almost impossible to get, or it was extremely expensive. Because we didn't have a track record in the region, despite being quite affluent and prove where the money is coming from, which is always a concern from money that comes from that region. So since the bank financing, debt financing from the banks was becoming quite tight, we were looking at alternative methods of financing. One of which actually is to invite white label hotel operators that could basically come in on a minority stake, 10 to 15% of the equity needed, and basically in that way put their skin in the game, but also help the investment, to get a better capital stack position. There are certain specialized banks actually that are quite keen to create interesting financial instruments, I would say in specific project bonds. And that way you can cover basically anywhere to 30 to 40% of the capital stack. And that definitely, gives a lot of boost to the viability of the project. Again, the project, of course, has to tick all the boxes of of these type of financial institutions. And then interestingly enough, there's certain banks that are not from this region that have become very recently quite extrovert, and they're willing to actually provide either a senior debt position or come in as a cost indicator with a local bank. And definitely that makes the whole investment financing picture more rosy.
Okay, so you see cases where Middle East investors find kind of senior financing also here in that region, or would that come from the Middle East as well?
No, it would come. No, we would find from here, here or from Europe, because the banks that I'm referring to actually are not from the CE region; they're from other regions, but within the European Union.
Okay.
There's another actually very useful financing instrument nowadays is the Recovery and Resilience Fund, grants or loans that are for the European Union countries. In some countries from the CE region, the governments have decided to take only grants, but there are certain countries like Poland, Romania, Slovakia that have actually chosen to take grants as well as loans. And in the current environment of very high interest rates, getting an interest rate of 1%, that makes it extremely lucrative,
Yeah, that sounds very nice. David, how do you see the investment climate in CE compared to other regions? You overlook a wider area, so what is your view on the CE region?
Yeah, I guess we had an investment panel dedicated purely to the investment part, but in a shortcut, the CE and SE region are very lucrative and interesting for the investors. Generally, we have got one kind of a uniqueness comparing to the Western European countries, and that's actually our growth pattern, which is historically proven already. So what triggers an interest of the investors is, let's say our constant compound annual growth rate, which is, I think, for the Central and Eastern European capitals, somewhere around 7.7% annually growth, compared to, for example, Western countries, Western more established countries, which were growing, by compound annual growth rate of 2.2, 2.5%. So combining actually the RevPAR growth, which is the major kind of a measure in our industry when it comes to the market performance, still, despite we have been a great jumpers and performers when it comes to the growth, our nominal values are very low in terms of RevPAR. So why we deem to complain outside of Prague or Warsaw or Budapest is actually there is no reason why there should be 40 euro difference between our RevPAR compared to the Western European capitals. So that transmits to the investors a huge upside, which still can be generated out of our region, and that's why they are interested to deploy the capital into our region. So the upside potential of the market. It's not only the income growth, which is appealing, but it's capital growth as well, because we have got one of the highest yields when it comes to the trading performances. So if you compare us to the Western European markets, there is still approximately 150, 175 bips difference between the yields achieved in our region compared to the Western markets. So if you combine these two together, it's representing quite substantial amount of the potential growth going into the future, because we are far away from stabilizing at the levels where we belong to. Another point is as well that our labor costs are low, so like our gross operating profit per available key are much higher than, for example, in the Western countries. So the investors are also very cautious when it comes to penetrating the markets where they can really look after engaging a very profitable operation. So
thank you. In my own experience, I see for years where I slightly envy my colleagues Michael in Warsaw and Lukas here in Prague for being on a market that seems to be flooded with money. And kind of in northern CE, there's a boom, in my view, sitting in the south for many years. So is there hope that it trickles down and that we will see more kind of, as these markets here seem to mature, at least from a southern viewpoint, that money trickles down into the new EU countries, Slovenia, Croatia, and further south, knowing that these are smaller markets, and so this is why they probably come second. But Do you see that happening?
You know, absolutely. Like 2019 record was achieved. It was 1.4 billion euro hotel transactions into Central and Eastern Europe. We are still.
Yeah, but of which, sorry to interrupt, I think 1 billion was in Poland and 300 million in Czech Republic and Hungary, and the rest was then in.
And the current trend is actually reversed. Actually, you see that Czech, capital market activity, or actually not only for hotels but all real estate asset classes, are ahead of the Polish, which, looking into robustness of the market in Poland compared to the Czech market in across all real estate asset classes, it's quite phenomenal achievement for the Czech Republic. But that's I think some kind of extreme which needs to be balanced out and back to the 2019 level, and hopefully we will use this pattern for a potential growth. What is missing in the other markets is definitely a good products, institutional products that can be introduced to the investors. We have seen on a multiple opportunities like Radisson Blu in Bucharest, or really sizable deals which are associated with the brand, which are attractive for the international investors and who are willing to really deploy the capital into these assets, because it's somehow proven that these assets are attractive when it comes to returns and are providing the certain security in terms of the potential growth in pattern and value going forward, rather than to go into the upside emerging market with the upside value add opportunity, which impose the additional risk. So we need more of the quality products, institutional, which can be traded and attract the appetite of the investors. But we are getting there. There are a lot of new openings in Romania, which we are tracing. There are plenty of new opportunities in Ljubljana as well. So, that's going definitely the right direction.
The package of a larger deal plus an international brand or several international brands would do well, you say, and would also take money further south. Would you finance that, Heribert? Is that something that falls within your kind of hunting scheme, or?
Yeah, absolutely. I mean, this ticks a lot of boxes for us. So, and I think we've come a long way in the region, in different countries and markets now in terms of professional products. I'm with you. I think there's still some way to go, but that had offered some really interesting and attractive financing opportunities for us as well in the many years we have been here active. So among our clients, usually we have a good mix of and healthy mix of international investors active in the region, but also a lot of professional regional investors who really have done a great job. I think over the last couple of years as well, and have developed some good attractive hotel products which are also bankable, financeable, and also good investment products. Yeah. So.
Okay, well, you could just mention the keyword bankable. What makes a product bankable? What should kind of people searching for money be happy to provide, and what increases the appeal to the bank?
So you mentioned, I think, in the beginning. So our current business and risk strategy is very much focused on existing properties with a strong track record and current ongoing cash flows. So we're very selective and more hesitant on new developments, especially greenfield developments. I mean, outside of the capital cities. We also now support very much or get a lot of requests now for capex, any kind of capex loans, for redeveloping, repositioning existing assets. Also, I think we get there later on ESG aspects and making assets also taxonomy compliant and more greener, which is very relevant here. And besides the asset quality, obviously the the operators or the operating model is very much of importance to us. As I mentioned before, we also have owner-operated and management agreements. So in this regard, we look very closely at the property cash flows in the setup, how the distribution works. Is there an international brand or franchise or affiliation? If it's a tenant, in many cases here in the region, we have local or operating companies or kind of white label operators who operate under franchises. So that's where we need to get comfortable with. That's obviously key when we finance that. And besides the sponsor, obviously for us as a lender, the sponsor is also key. So it's the asset and the sponsor and the right operating solution and operating structure.
Thank you. David, what is your view? Do you see any trends when it comes to financing deals here in the region? What is preferred, what is not preferred, what do investors particularly like, and how do they finance themselves?
I would say the biggest trend these days we see is, let's say, the bank being very selective. You know, they have a possibility, like, you know, compared to 2019 when it was very easy to obtain the financing, and typically any investment transaction was subject to leverage or to obtaining the financing. These days, and we did multiple transactions since the beginning of this year, none of these transactions were literally using the leverage angle, so it was financed all on equity. So that's, I would see, from the investment perspective, is a new trend, and it's a very understandable trend because, like you said, there is a lot of dry powder available on the market. There is a lot of equity available on the market, and better than to be eaten up by the inflation or the cost of the funds, it's much better to deploy and just try to generate a certain direct profit on the equity invested. But with the caveat that, you know, it's assumed when the market will recover back, you know, the initial investment will be refinanced. So there's a little bit, you know, different towards the pre-COVID period, where actually this 1.4 billion, approximately 70% of that was involving the leverage financing, and out of the 70%, it was on a favorable LTV margins. These days, LTVs are compressed significantly down. If you speak about the lease contract, the banks these days either refrain from even look into the hospitality angle, like simply the risk departments thrown away actually every hospitality element out of the window from the real estate quota. But there are some, for example, like Heribert's Erste, who are willing to be educated about the new sentiment on the market. They are much more understanding the volatility of the market, and they are able to be educated about the new trends. So, like, for example, before in a lease contract, nowhere to be having a hand on a variable income. These days you have got in a lease contract the pandemic clauses, which allows you to touch on the turnover element when the pandemic clause is triggered, for example, which would not be the case any time before the pandemic crisis. And much more open to the variable income and the risk associated with it, because there is a upside potential, you know, over it. So instead of relying on the grace period on your principal and call for the certain period, you rather want to have the certain portion for the revenue, at least to sustain the part of the debt service coverage, debt service. On the debt service as well, the banks inclined to reduce the debt service coverage ratio compared to the pre-COVID crisis, because they know the operators were lacking on the cash flows from the hotel operations. And playing with the hedging, because I think it's something actually which is quite important in our region, where you have got multiple currencies, and I think that represents most likely a lot of headache to your risk department as well, how to factor in if you are providing the financing in the local currencies, wherever actually you can tip in and try to structure all the financing in euro. So these days, it's very normal that lease contracts are being negotiated in the euro currency, even that the local currency is completely different, in order to minimize the hedging losses and being able to touch, let's say, the euro financing, which the big lenders are providing.
Heribert, you want to respond?
Just to add, Jan, it's a good point. Thanks, David. I think one of the benefits for borrowers, for our borrowers is that we can offer euro-based financings also in non-euro-based countries here in the region, so in Czechia or in Poland or in Hungary, especially if the lease is a euro-denominated lease, which takes out the FX risk, or also if you don't have a lease but a managed property. In many markets here in the cities, you have a natural hedge because you have a large share of international guests as well. So that we also take into consideration. I think that makes, especially now if you look at the base rates, different base rates, that's an attractive proposition for investors looking for financing here.
Nikos, how did the rising Euribor change your challenges? So how do you advise your clients? How should they react on that, or what was the consequence for you?
You know, as a financial advisor to our clients, basically we examine every project independently, and we try to come up with the optimum, but also the most realistic strategy. As David said, right now, a lot of our clients, we actually suggest to them that if they can, go all equity and wait to see, you know, in the next 6 to 12 months how the interest rates will pan out. There's some projections say that, you know, by next summer there will be some stabilization, which we all hope so, but at the same time it's speculation. So, and especially the investors from the Middle East, they're, I guess, blessed enough with enough liquidity to use it when needed. And I think this is the time that we actually suggest to them to use it. At the same time, it's interesting because we have certain clients that, you know, they're not from the Middle East, but they're from Europe, and the increase of the interest rates actually has made them more keen to actually invite co-investors because they prefer, instead of going to the bank, they prefer to, you know, bring in someone that has also the expertise that they can actually use and put their skin in the game and combine forces, basically. And that's something that pre-COVID, that was not the case. The majority of people wanted to come in, you know, get their debts, be their own bosses, with a bank, of course, and then move on. Now you see more synergistical attitude, I would say, from the investors. At the same time, again, I will repeat that the Recovery and Resilience Fund has been a blessing for the countries that actually are able to use it, because yes, you need to, in order to get into the RRF, you need to get a loan, but nevertheless, the net effective interest rate, if you combine the amount that you're going to get from the RRF plus the bank, definitely brings down the interest rate to a much more competitive figure than what it actually is now. And
Right.
it's for the people that don't want to actually have anyone else co-investing with them. That's an option that we actually propose to them.
Bringing down the interest rate, rumors say that even compliance with tougher ESG criteria or just becoming greener knocks the margin down and is so favorable. So is that true? Does that change things?
Now we are moving to ESG again and green. So
Yeah, it's inevitable, Heribert.
It's
you know
good.
it.
Just now, it's great that I think it has come too short the whole day anyway. So as you.
By the way, a short question to the audience: who came by train to Prague? Okay, thank you. Just for the ESG-ishness of the whole session.
The green and the whole discussion now, the whole ESG topic, sustainability, green investment, green asset is with, you know, starting obviously with 2015, the Paris climate thing, and then in 19 with the European Green Deal, especially in Europe, I think is really getting a lot. You know, it's a really key consideration. Every investor should now take into consideration and make. It's played through the lenders. So all EU lenders have from the regulators very strict targets now and strict requirements which we have to implement. And I think, like most other lenders, we've been quite busy the last 12 to 18 months after COVID, dealing with that and analyzing our existing finance portfolio to understand what we actually have in terms of, you know, on the financed assets in terms of average energy consumption, CO2 equivalent per square meter and year, something that we need to assess. That we have done now and completed that exercise. So now we exactly know by asset, by country, what are the average values in this regard. And to be honest, the last, you know, how this is really now an important factor in our underwriting. So when we present now new financings into our investment committee, probably the first question now is, okay, what's the, on that asset, on that property, what's the CO2 value on that property? What's the energy consumption on that value, on that property? So coming back to your question, at the moment, might bring you a small margin improvement, a slightly lower margin, not much to be honest, but it's rather more. It's not a question about getting a better margin anymore, but it's going to be a question: will you get financing at all for this property or not? And I'm not saying that only green assets will be financeable or bankable, but if you have a, let's call it brown asset, and there's a lot of existing assets which are not obviously compliant with the taxonomy requirements at this point, you need to have a clear concept, and that's what we are already requesting now with every initial request, so that you present us, have you done an ESG assessment of your portfolio, of your asset, what's your planned strategy, if it's a brown asset, what are you planning to invest during the loan tenure? So we are really discussing now very specific capex plans, which will be put into the facility agreement and the loan agreement. So that's where we are moving to, and I think that's where all the lenders are moving into, and this is only getting intensified by reporting disclosure, the new Corporate Sustainability Reporting Directive, where banks starting with next year and large investors, and will include more and more types of companies as we move along, 26, 27, will have to publish these rates and these ratios, then it becomes comparable, and then it's also a question for our investors, our shareholders, and that trickles down obviously to the investment and financing decisions.
So it will maybe not earn you a better margin, but it definitely matters to you, and it might become a condition for any financing.
It has been made to matter to us,
Okay.
as a lender.
Okay. Nikos, what about you? You're further south and further east in the region, and does ESG matter as much as it does probably in Austria and Czech Republic? Or can you give any examples where you incorporated that already in a project?
Well, we are, I would say, blessed to have clients that actually are quite sensitive about ESG matters as a philosophy, as a personal philosophy, and I think that starts to create a very strong foundation. Because then, of course, as Heribert said, yes, the banks do give incentives for green financing, and we have actually taken for acquisition of existing properties and renovation or some greenfield developments, we are actually convincing our clients to hire consultants with a very strong ESG record in hotel projects, because that makes it easier, of course, to implement all the measures and the standards that the different type of certifications, which are actually quite common now in the market, like BREEAM from the UK or LEED from the US. And we see that banks, as Heribert said correctly, they are keen to give you a small carrot. Let's say we've seen carrots 0.2, 0.4%. But in addition to that, also give you more flexibility with regards to maybe a longer grace period, starting with paying your debt service with lower amounts, ramping it up, so which helps also your liquidity when you're a newly opened property, and even to reach to the point where it can offer you even a bigger balloon payment at the end of your loan. So this, of course, is on a case by case. But if you put all these things pieced together, it creates a very nice puzzle of incentives for any investor that wants to, follow the ESG trend. Now, how much is that popular in South and even more South down in the Middle East? It's something that is not as much as we were all hoping, but it's something that is new, and I think that the more the technologies actually will create the economies and the economies of scale on the operational level and even the construction level, that automatically will incentivize even the investors to look for it instead of being forced to follow those guidelines in order to get a discount on the interest rate or get a certification because maybe the brand wants it, or if they want to sell their property to a fund, it would probably ask for it upon the sale.
Thank you. David, let us know, how do you think, or how do you experience, how does sustainability and ESG, what impact does it have on valuations, on the future sellability of of a property. What do you
It's
think?
interesting to see how various parties are perceiving the ESG matter. You know, I have seen a lot of jokes about like who is the last one leaving the bar and taking the bill. You know, who will cover it, who will pay for it. Operators, you know, associating more with the, you know, aspirations to save on the shampoo bottles and plastics and fill up the containers. And, you know, the ESG is a very complex situation, and that's why actually we have a dedicated team, you know, part of our service lines in CE, because it's happening, and I think we are still as a market deemed to underestimate its impact, and it's behind the corner. The fact is that the hotels are biggest polluters, biggest energy consumptors after retail and healthcare. That's the fact. There is a long pattern which needs to be done in order to really shape up the industry and to really make sure that we are following the EU taxonomy matters, which are in our region, at least, you know, starting from 2025, 2026. So really, if you are a developer, you need to adopt already, or you have had to adopt already. If you are the owner of the existing asset, you better run to your financing bank and try to work out the solution how you can adopt to the recent changes, because you will be punished. You will be punished either on the exit when selling your property. In a matter of fact, you know, it was a nice curve, exponential curve, being seen in due diligences of the hotel transactions over the past 3 years. It have the ESG DD was part of 38 in 2020%, 45, and then 77% of the deals in 2022. Okay. So it's real, it's happening. The investors are very cautious about it. They are implementing it, and they are either using it to really confront the owner with the fact that he has a serious problem and he needs to take serious steps when it comes to adopting these changes, either in the discount on the pricing or any other adoptions. And in terms of the financing, I think that, you know, the banks swiftly adopted to the ESG matters. Heribert will excuse me, I think that there is a learning curve on the bank side as well, because we all are waiting for the market really to show us in terms of transaction, how does really the yield changed and compressed because I'm ESG sustainable. We are missing this market evidences yet to really say, you know what, if you are ESG compliant, I will give you a 50 bips discount, you know, whatever. So I think the entire market is in a learning curve, and it will get there for sure, but, you know, we need to take the active measures to really prepare that it's behind the corner, it's here.
Thank you. I mean, for me personally, it's a relief to see that ESG starts to matter. I didn't glue myself to the street yet, but I understand these people, and I think it's something that really should worry all of us, or at least should concern all of us. Are there any questions from the audience? Go ahead. You need a mic? Wait, you get one? Yeah, you have a voice, but also a mic, so in combination.
Thank you. You've mentioned how you evaluate projects that have a plan for ESG, and how exactly do you evaluate those for potential financing? Do you have like specific criteria or specific areas that you look at more specifically when it comes to ESG, or is that sort of a work in progress for you as well?
Well, how we have implemented it now is that it's critically part of our technical assessment. So when we consider new financing, in this part of the underwriting, we have our in-house technical advisory team, and they usually do for larger assets we call technical object rating, so a complete technical assessment of the property. And this part, an integral part now, is ESG assessment with that. So there we already request and will ask a lot of questions and ask for a lot of information from investors or clients seeking finance with us now. And this is a fairly detailed catalog of criteria. So there's dozens of criteria which are assessed in this regard, and that has, as I mentioned before, really now is strongly increasing importance in the financing decision in general. We also look at, on a property level, we go very much into detail, like looking at the Krempfad. So if you haven't heard about the Krempfad, it's time to familiarize yourself as property owners with that as well, to determine, for example, straining asset, the straining asset point. And if that's within the loan period we are financing, 5 to 7 years, then we need to talk. What are you planning to do to address this?
Time's up, this thing tells me, but are there any other questions? I would just break that rule. Here you go, in the back.
I have a quick question on ESG. Why do we only talk about E? Why don't we talk about S and G too? Is E prevailing, for example, for banks? Is that the most important, or the social part and the governance is not interesting or important?
If I may try and answer, I believe the S and the G, at least the G is a more a legal thing and easier to achieve. The S seems to be connected to humanity as well, but the E is something that people really need to get accustomed to. E is probably more life-changing than S and G, and that's why people find it harder. But sorry.
I would add, if you take sustainability really serious, then you take a holistic approach and obviously consider all three very closely. And it depends on which asset class. So the social, for example, I think is very relevant in residential real estate, for example. But very much so in hotel real estate, absolutely. I mean, for us, to address your question, yes, very much focused on the E at the moment, because we're talking about these hard figures and numbers, you know, on energy consumption per square meter and CO2 footprint per square meter, so that's very much associated with the E. And we're talking about, that's very much limited to the operational phase only. So I think, but this would be a separate discussion to take a holistic life cycle view.
And to a certain extent, the S is always answered by the brands or operators directly. So the E is always something which is also driven by the EU taxonomy. You know, as Heribert mentioned, you know, it's something which you can measure, you can quantify, and you have a hard fix what you need to achieve. So that's why actually the E is a top priority at the moment.
Anyone else? If not, I would close this session. Thank my panelists. And thank you very much for attending.